Picture this. You've spent 40 years saving, investing, and planning for retirement. You finally start receiving your old age security payments. But then, out of nowhere, your next deposit is smaller. You didn't miss a form, you didn't owe taxes, and you didn't do anything wrong. You simply earned $1 extra in income, and it just cost you up to $7,500 in clawbacks. That $7,500 isn't tea from $1. It is the cumulative loss over multiple years when you repeatedly cross the threshold without planning. Today, I'm breaking down how the 2026 OAS Clawback really works, who it affects, and why most Canadians don't realize they're losing thousands every year because of it. By the end of this video, you'll know exactly how the clawback is triggered, what your personal threshold is, and how to calculate your exposure with a real example. Pause right now and ask yourself, did your income cross $90,000 last year? If you're not sure, type unsure in the comments with your approximate income, and I'll tell you if you're in the clawback zone. Let's start with what's actually happening. The Old Age Security Program is designed to give every Canadian over 65 a basic income supplement in retirement. In 2026, the maximum annual OAS payment is $8,415 per person. But here's the catch. OAS isn't universal. It's income tested. Once your total annual income passes $90,997, the government starts taking that OAS money back at a rate of 15 cents for every additional dollar you earn. That's what's called the OAS Clawback, or officially, the OAS Recovery Tax. Let's run through an example. Imagine you're retired, and your total taxable income for 2026 is $95,000. That's $4,000 above the threshold. Multiply that excess by 15%. You lose $600 of your OAS benefit next year automatically. Now imagine your income was $140,000. That's $49,000 above the threshold. Multiply that by 15%, and your entire OAS benefit, $7,350, vanishes. The government doesn't reduce your OAS payment month to month in real time. They wait until you file your tax return, and then the CRA recalculates how much OAS you should have received. If your income was too high, they'll deduct the clawback from next year's payments. Or, if you're still receiving OAS monthly, they'll withhold a portion each month until it's repaid. That's why so many retirees are blindsided by it. It's not a penalty. It's not a separate tax. It's a reduction of something you already earned, triggered by a small increase in income that you might not even notice. And here's the brutal truth. This isn't just about high-income retirees. The clawback threshold hasn't kept up with inflation or wage growth. 10 years ago, $90,000 was considered high income for retirees. In 2026, it's barely upper middle class. Many dual-income couples easily cross the line just by combining CPP, OAS, RRSP withdrawals, and small investment returns. This is why the OAS clawback has become one of the most misunderstood traps in Canadian retirement planning. Let's talk about why this clawback exists in the first place. The original idea behind OAS clawback was fairness. When the program was created, it was meant to help lower and middle-income retirees maintain a basic standard of living. High-income retirees were never supposed to receive the same benefit because they didn't need it. That's reasonable in theory, but in practice, the thresholds haven't evolved with the economy. Here's the data. The OAS clawback threshold has increased by only about 1.5% per year over the past decade. Inflation and wage growth have averaged more than 3% per year. That means every year, more and more retirees are pulled into clawback territory simply because of inflation, what economists call bracket creep. It's not that you're suddenly rich, it's that the line hasn't moved fast enough. Let's look at some real-world examples of how this plays out. Example 1. Sarah, age 68, lives in Calgary. She earns $72,000 from her company pension and takes $15,000 per year from her RRSP. Total, $87,000. She's fine, below the threshold. But one year, she decides to cash out a small GIC that matured for $4,000 of interest income. Total income, $91,000. She just triggered the clawback. That single transaction will cost her $600 in lost OAS next year. Example 2. David and Louise, both 70, live in Vancouver. They each receive full CPP and OAS and draw $40,000 each from their RRIFs. That's $160,000 in total household income. Each of them is over the threshold by about $50,000, meaning they both lose their entire OAS benefits, $7,350 each. Together, that's $14,700 gone. Now here's the big one most financial advisors don't mention. RRIF minimum withdrawals are mandatory, starting at age 72. You can't avoid them. And as your RRIF balance grows with investment returns, those withdrawals increase every year, often pushing retirees over the clawback line even if they started below it. It's not about bad planning. It's about not planning early enough. That's why experts call the OAS clawback one of the most expensive stealth taxes in Canada. It's not in your face like income tax. It happens automatically, quietly, through the back end of the CRA system. So, how do you protect yourself? First, you need to know your exact exposure. The math is simple but critical. Take your total projected income for the year, including pensions, RRSP or RRIF withdrawals, investment income, rental income, and even part-time work. Subtract $90,997. Multiply the remainder by 15%. That's your estimated clawback. If you get a negative number, you're safe. If you get a positive number, that's how much of your OAS benefit you'll lose next year. Second, plan your withdrawals smartly. Many retirees automatically withdraw from RRSPs or RRIFs just to use it. But those withdrawals count as taxable income and can push you right over the line. Instead, consider splitting withdrawals across years or using a spousal RRSP if your spouse's income is lower. The goal is to stay just under that $90,000 mark, especially in your mid to late 60s when your RRSP balances are still high and mandatory withdrawals haven't had started yet. Third, be cautious with investment income timing. Capital gains, dividends, and even bond interest all count toward taxable income. Selling investments late in the year or triggering capital gains in a strong market can push you above the limit without realizing it. That's why smart retirees spread their withdrawals across multiple accounts: TFSA for tax-free income, RRSP or RRIF for taxable withdrawals, and non-registered accounts for flexible planning. Now let's apply all this to a real example using the 2026 threshold. Assume you're single, retired, and receiving both CPP and OAS. CPP pays $14,000 per year, OAS pays $8,400, and you draw $30,000 from your RRIF. That's $52,000 total, well below the clawback line. You're safe. But now you decide to sell an investment property that generates capital gains of $50,000. Suddenly, your income jumps to $102,000. You're $11,000 above the threshold. Multiply that by 15%, and you'll lose $1,650 of your OAS next year. Now imagine that gain repeats for 2 years, or you keep withdrawing a little too much from your RRIF. The cumulative loss over 5 years could exceed $7,500, money that would have stayed in your pocket with a small amount of proactive tax planning. So here is your takeaway. The OAS clawback isn't just about losing benefits. It's about understanding your marginal income zone. Every dollar above that line is effectively taxed at 50 cents or more once you factor in the clawback. That's why income splitting, TFSA withdrawals, and timing your capital gains are essential tools. These strategies don't eliminate the clawback. They delay or minimize it. The key is controlling when your income shows up on paper. Before we wrap up, I want you to do something right now. Open your CRA My account and check your 2025 Notice of Assessment. Look at your net income before adjustments. If it's above $90,000, you're already in the clawback range. Use our calculator linked in the description to enter your income and see exactly how much OAS you'll lose in 2026. Then comment your income bracket below, under 90,000, 90 to 110, or above 140, and I'll reply with your exact estimated clawback. Have you been hit by the OAS clawback? Type yes or no in the comments and include your income. I'll calculate your exact exposure and show you how to minimize it next year. Subscribe to Maple Money Data if you want data-driven retirement analysis every weekday. We break down programs like CPP, OAS, RRSPs, and TFSA with real numbers and real examples, not just generic advice. In our next breakdown, we'll cover how to structure your RRIF withdrawals to avoid triggering both the OAS clawback and higher marginal tax brackets, potentially saving you more than $10,000 over the next decade. Don't let the clawback surprise you at tax time. Understanding this system isn't just about saving money. It's about protecting the retirement income you've already earned. See you in the next video.